Thank you very much, Kyle. And thank you very much for attending our New York tax incentives for farm employers, overtime investment, and employee retention incentives. We will discuss the current status of all these incentives. Some are in place now, some are yet to be finalized, and there's a lot that needs to take place between now and probably a year from now when more things start to take effect. This webinar is co-sponsored by Farm Credit East, Cornell Cooperative Extension, Agricultural Workforce Development, New York State Department of Taxation and Finance, New York State Office of Governor Kathy Hochul, and New York State Agriculture and Markets. We are really pleased to have a distinguished panel of speakers for you today. And I would like to mention for the question that has come up and will come up is that today's broadcast will be recorded, and the recording and slides will be posted to our website, farmcrediteast.com/webinars, for review later for those who cannot attend today. I would like to mention just a brief disclaimer that this is not tax or legal advice. This information is presented on an informational basis only, and does not establish a contractual obligation. So I have to put that mandatory disclaimer in there, and that things are subject to change by the legislature and policy. I guess with that, I will turn things over to Mr. King for a brief introduction from his perspective. And Mr. King, perhaps you can give us a brief self-introduction.
Good morning, everybody. Chris, thank you. My name is Kevin King. I'm Governor Hochul's Deputy Secretary for Food and Agriculture. Pleasure to be with you today. And today is June 21st. It's the longest day of the year, and I am so happy you've decided to spend a little bit of that extra daylight learning about the tax credits here and some important information that I think will be helpful to you going forward. You know, Governor Hochul made a significant commitment this year in her State of the State and followed up in her budget with a historic level of investment in agriculture. No governor has put as much money into agriculture as Governor Hochul has this year. And we're here to talk about a little piece of that investment, a very significant piece of that investment as we come off the pandemic, the challenges around labor and workforce that all of you are confronted with. And these tax credits are designed and intended to help provide some support. It's something that's unique to New York, not available in other states. And we think while it's not going to solve problems, it is going to help blunt the edge. It's going to help you make sure that you've got some of the most effective, efficient workers that can be made available in the current climate available to you. And then obviously the workforce retention credit, which doubles and is extended, and then the investment tax credit, which is something that New York Farm Bureau has asked for. It's been a priority for many years, well-timed, coming off of a lot of uncertainty over the last several years. So with that, I'm going to turn this over to the experts. I do want to thank Farm Credit for hosting this. Thanks to Chris and his team, and Dr. Stupp at Cornell, who tolerates and responds to all my questions. A tremendous source of information. I know valued by many of you in the industry as well, doing a fabulous job. And then really thanks to our folks here from the Department of Tax and Finance, Francine and her team, and Ag and Markets, Nicole LeBlanc and the team over there that are administering these programs and have made themselves available so that you can hear firsthand for how these programs will run and get some answers to your questions. So with that, I'll turn it back to the team. Thank you.
Yeah, thank you very much, Mr. King. Before I turn it over to Rich, I would just like to mention that we will have the opportunity for attendees to ask questions, which we will get to as many as we can. The Q&A session will be after everyone's presented, because many questions hopefully will be answered as we go through things. To ask a question, you can do it at any time. Just go to the GoToWebinar control panel which is, you can expand it by clicking the red arrow in the upper right-hand corner of your screen. You can type in a question and we will get to them during the Q&A period. And please avoid asking questions that are super specific to your situation or that reveal any personally identifiable information. We want to keep the questions general and speak to them without identifying any individual characteristics. I guess with that, I will turn it over to Dr. Stupp of Cornell's Director of Cornell Ag Workforce Development.
All right, thanks everyone. Glad to be here with all of you. Are you seeing my screen now, or my presentation? Perfect. One thing I would just draw your attention to there is our website, agworkforce.cals.cornell.edu. We have a page on there on regulations. We try to keep things up to date on what's happening with many topics. Of course, overtime being a huge one in the last year or so. I know we're talking about 3 different tax credits today, but certainly the overtime one is drawing a lot of attention. And so with that, I wanted to give us just a little bit of a backgrounder on how we got to where we are today. It's always good to keep things in context. So back in 2019, the governor signed the Farm Fair Labor Practices Act. Yes, okay, I won't say that one again, FLIPA. In 2020, January 1, FLIPA went into effect, including the 60-hour overtime threshold. And so, I still speak to employers here and there who aren't fully up to speed on all the things that are in place now. So I want to encourage everyone to make sure that they do that and learn about the laws that are currently in place. Then we had the whole wage board process, and the wage board was built into the original law. And that process started back there in 2020, but also another process started, and that was COVID, and that kind of messed things up. The wage board went from one in-person hearing to then a series of online via Zoom hearings, which ended up being quite lengthy. And at the end of that year, the wage board voted to basically continue things as they were with the 60-hour threshold for a further year. And then at the end of 2021, the labor commissioner at that point decided that there would be more hearings to further study the issue. That was January then of this year. There were additional hearings, again, quite lengthy. Many producers, industry folks there, representatives of farm worker advocate groups, 4 hours at a time was typical for these hearings. Very contentious. Wage board at the end then voted 2-1 to recommend changes to the Commissioner of Labor, and that brings us up to where we are right now. My understanding is that there is a report being written, and that based on what the wage board voted on and their recommendation, which I'll share here in just a moment, they are preparing that final report. And any changes then will be made, and those changes will be implemented by, of course, the Commissioner of Labor and the governor. So with that in mind, we don't know at this time exactly or for sure what, if any, changes will take place. But our assumption with this webinar is going to assume that the recommendations by the board are what's going to happen. But until we know that for sure, we don't know, but it's a good assumption. Anyway, with that being said, I wanted to share what is that recommendation that came out from the wage board. Well, it is a 10-year decline of the overtime threshold, and that would actually start in 2024 would be the first lowering of the threshold. So right now it's at 60 hours, so nothing essentially would happen until 2024. At that point, it would lower by 4 hours to 56. And then you can see those stair steps down every other year. Then it would drop another 4 hours until the overtime threshold for New York farm workers gets to 40 there in January 2032. So that's the proposal. That's the recommendation from the wage board. And I just wanted to share, because I've had a number of conversations with producers about this, with employers about this. So I wanted to share an example here of what this exactly means, what portion of payroll would be reimbursable. So if you follow my thoughts here on this example, we've got the left-hand axis, then the vertical axis is pay per hour, and then along the bottom we've got hours worked in a week. So we're looking at a weeks of pay. So let's presume that it's the year 2027. So our overtime threshold is at 52 hours in the week. So what that means is that in this employee's base pay is $16 an hour. So for that first up to 52 hours, it is $16 an hour that they're getting paid, and that is all coming from the employer. So the blue area is what basically the employer is covering, and then the green area would be pay that the employer covers up front, but then is eligible for a tax credit. So essentially the employer would get that reimbursed to them. One thing I would point out then is that it's only the overtime premium, right? So that first $16 of base pay, that's never reimbursable. So only that overtime premium, that 8 hours, starting at 52 hours and then going up to 60 hours. Now, all the way into the future, when it's at 40 hours, then there will be green bars showing beginning at 40 hours. So that portion would be reimbursable. And then another important note is that any hours above 60 hours are never reimbursable with the proposal that we have going forward. So hopefully that gives everyone a picture of what the reimbursement will be. Okay, so we'll shift gears here. I just wanted to give that little background and clarify a couple of things, but we're moving along already. Here's our agenda, the opening, Kevin's remarks, that's my background and agenda. We're already on item 4, so we'll jump, we will cover farm-related New York tax credits, and then the certification process that will take place. Then we will move on to looking at some tax strategies. And Chris will facilitate for us a Q&A panel, which we're going to leave some time for at the end. And then I'll pop back in to close this out. But that's basically the agenda that we have for today. And so I will turn it back to Chris to introduce our next speaker. Thanks, everyone.
Great. Thank you very much, Dr. Stubb. Next, we have Francine Schoonmaker. Am I saying that correctly? Hope so.
You are.
And she's with New York State Taxation and Finance, and she is here to give us some insight into all the tax credits that we are discussing today, along with Nicole LeBlond, who will be co-presenting as the Deputy Commissioner, New York State Department of Agriculture and Markets. We can see your title slide, so I think you're ready to go.
We are. Good morning. I am very happy to be with all of you today to learn about these tax credits from the recently enacted budget that will assist your farming businesses. In this presentation, we will be discussing changes to the investment tax credit for farmers and the farm workforce retention credit, plus the new farm employer overtime credit. But first, let me explain who these credits generally apply to. You're generally eligible for these credits if you're engaged in the operation or management of livestock, dairy, poultry, fish, fruit, fur-bearing animal, and vegetable farms. But other activities may also qualify, like the production of maple or cider, managed Christmas tree operations, commercial horse boarding operations, sale of wine or cider from a licensed farm winery or farm cidery. Income from these activities is treated as farm income for determining credit eligibility. However, each taxpayer's situation is unique and eligibility may vary depending on your circumstances. So let's get into the details now. This year's budget included some changes to the investment tax credit. For property placed in service on or after April 1st, 2022, the investment tax credit for eligible farmers will increase from 5% to 20%. On property principally used by the farmer in production of goods by farming, agriculture, horticulture, floriculture, or viticulture. As a refresher on this credit, you're entitled to the investment tax credit if you or your business placed qualified property into service during the tax year. It is refundable for new businesses, but that's only during the first 5 years. And you would file this credit on either Form IT-212 or CT-46. And these forms will be updated for 2022 to reflect the increased rates for farmers. Changes were also made to the Farm Workforce Retention Credit. The amount of the credit doubles from $600 to $1,200 per eligible farm employee. The credit program was extended through 2025, and that credit amount increase applies for years 2022 through 2025. If you're not familiar with this credit, it applies to eligible farmers whose federal gross income from farming for the tax year is at least 2/3 of federal gross income from all sources in excess of $30,000, and that includes payments from the state's Agricultural and Farmland Protection Program. The definition of farming for this credit includes the operation or management of livestock, dairy, poultry, fish, fruit, fur-bearing animals, vegetable farms, and also includes operation or management of plantations, ranches, ranges, and orchards. This credit is filed on either Form IT-647 or CT-647, and we have a technical service bulletin on this, which has more specific information. So you could see TSBM 16-7C for additional information, which can be found on our website, www.tax.ny.gov. And now the new farm credit, the Farm Employer Overtime Credit. This credit will equal 118% of any additional overtime paid as a result of the phase-in of the new 40-hour overtime threshold. The credit base is overtime paid for hours worked between the new threshold and 60 hours, as Rich just explained. And the credit is contingent on the overtime threshold being lowered from 60 hours per week. This credit has an advanced payment option for overtime paid between January 1st and July 31st of the applicable year. Taxpayers must apply to the Department of Agriculture and Markets by September 30th of the applicable year to get advanced payment. Overtime paid between August 1st and December 31st of the applicable year can be claimed when you file your tax return for that year. In addition, if no advance payment is requested, then you can claim the whole year from January 1 to December 31st when you file your return. Unlike the other two credits I mentioned, it's relatively new and we haven't gotten far along in the process yet, so we don't have a form number for this one yet. And if, as Richard indicated, the adoption goes through the way that it's currently planned, it probably won't be effective until 2024 for you. So let me turn it over to Nicole, though, to talk about what we're believing the advanced payment process might look like. Nicole?
Thanks, Francine. Good morning, everyone. The Department of Agriculture and Markets is going to be tasked with managing the application and certification process for these advanced payments. So I'm going to walk you through some of the critical items that relate to those functions. The first is application for advanced payments. So as Francine just noted, the department is working closely with Tax and Finance to figure out the easiest way for farms to report the information that will be necessary to compute the credit. We expect the application to be similar to the credit form that you would need to file with your tax return. And the application will include both information about the entity and information about the employees with the overtime paid to them. Information that we expect to collect about the entity. So here's what we're looking for. We'll be looking for the name, ID, type of entity, and the ownership information. Ownership information is necessary to ensure that the advanced credit payment goes directly to the individual taxpayer. If for whatever reason the farm entity cannot provide this information by the advanced payment application due date, they can always forego the advance payment, which Francine just mentioned. They can provide this information as they claim eligible overtime paid for the entire year, which is January to December, when they file their final tax return with the Department of Tax and Finance. So information needed about the employees. Keep in mind that this is information that will be needed for each employee. So we anticipate you'll need to supply information such as the name, the ID number, zip code of where the work is performed, total overtime hours worked, as well as the overtime rate and regular rate of pay. We do realize that rates could change, so you may need to report the same employee several times if their rates increased during that period. Here are some additional items that we think are important for you to know as you're thinking this through. So first, the overtime for executive officers would not meet the definition of a farm employee, so therefore they would not be included. And second, licensed farm wineries and cideries whose sale of wine and cider amounts to more than 50% of the farm income may only claim the credit for employees who are employed directly on the agricultural property. Taxpayers not employed on the agricultural property, so for example, employees that are working in a tasting room or in sales, will not qualify. This limitation is consistent with the Farm Workforce Retention Credit. And supporting documentation. We are still working out details, but here are some of the items we think will be necessary to certify the credit. So you're going to need records that support all of the information provided to show the rates and amount of overtime per employee, and that also support what you put on your application or your claim. So payroll forms or records to show employment periods and wages paid per employees. They should reflect the hours and the rates of pay, and they should also document where employees worked during the week. For example, which location, plot of land, etc. So some details to verify that as well. So what happens after you apply? You will receive a certificate. It will be issued to the entity with the amount of the advanced credit as well as a unique certificate number. The entity will be responsible for sharing it with the owners, partners, or shareholders so they can claim the advanced credit. And with that, I'm going to turn it back over to Francine to talk a little bit about claiming the advanced credit. Thank you.
Thanks, Nicole. So once you have the certificate from Ag and Markets, and you or are shared the certificate, right? You need to come to the tax department to actually claim the advanced credit. We've only just begun to work on this part, but we have other advanced credit programs, so we would expect that it's going to be handled the same way. You would take the information from the certificate, then come to the department's website through your online services account, enter some information about the certificate, and verify information about you, like where to mail or deposit the check. And once we verify that information, the check will be issued. If you receive an advanced credit, it will be deducted from the annual calculation on your credit form that you file at the end of the year with your taxes. And so it should be pretty simple. Now I just want to cover a couple of other things with you. The budget also included a change to the small business income modification for your income tax returns, effective for taxable years beginning on or after 1/1/2022. The definition of small business was expanded to include non-farm LLCs, partnerships, and S corporations with less than 1.5 million in New York source gross income. And the subtraction modification was increased from 5% to 10% of net farm income included in federal adjusted gross income. This applies to farmers or farm businesses with less than 250,000 in net farm income. Basically, any farms that were previously claiming the 5% subtraction modification would now be able to subtract 15%. Additionally, I wanted to take the opportunity to point out that we have a lot of information on credits, exemptions, and deductions for farmers on our website. So please remember, this is a good resource for you. Just go to our website, www.tax.ny.gov, and search farmers. That's all we have for you today, so thank you for listening.
Okay, thank you very much. Next, we are going to go to Dario Arezzo to talk about farm employer tax strategies to consider. Dario Arezzo is one of our tax gurus here at Farm Credit East. He is an expert on all things farming and taxation, and I will turn it over to Dario to give us some of his insight.
Thanks, Chris. Can you see my screen?
Yes, we see your title slide.
Perfect. I appreciate it. I want to spend the next 10 minutes roughly on just some tax strategies, mainly around the investment tax credit, as I think there's some opportunities there. But before I do, just one quick point out, I think the farm workforce retention credit that we mentioned goes to $1,200 now this year. That is for workers that work over 500 hours in the year, including H-2A. And what's kind of cool about that is that there's a provision there where if a worker gets sick or something and you have to hire somebody to replace that worker, you can kind of merge the hours. With COVID going on, that's come up a few times. So just a helpful tidbit in that regard as far as the farm workforce retention credit. The investment tax credit now being 20% on basically CapEx that you buy for the most part, unless you buy it from a family member. Usually any CapEx that you buy, 100 grand of equipment, you now get $20,000 of ITC. That's pretty cool. We're going to talk a little bit about Section 179 and bonus depreciation, which are essentially different ways to accelerate deductions on CapEx. Now, obviously, you buy some new equipment without doing either Section 179 or bonus depreciation, you get that over 5 years. But there are accelerated methods to do so. Yeah, most farmers are aware that Section 179 lets you directly expense that CapEx up to this year $1,080,000, so long as you don't buy more than $2.7 million of eligible CapEx. Similar to bonus depreciation, lets you to write off 100% of your CapEx in the current year as well. There's a few nuances between the two that we're not going to have time to get into, but practically speaking, bonus depreciation you could use on general purpose barns where you can't for Section 179, for instance. So for ITC, for New York State, why is this conversation important? Because you cannot claim the investment tax credit on assets that you use Section 179 on, or rather a portion of them as well. For example, you buy a 100 grand piece of equipment and you take Section 179 on $80,000 of that, it leaves you with $20,000 of Section 179 of an asset base. You can take that 20% on that remaining $20,000. If you expense the whole asset, you have no ITC availability. The middle box there, no SDA for New York State. So in other words, when we talk about bonus depreciation federally, we get 100% of a write-off, but New York State doesn't recognize bonus depreciation generally. And so we just get normal depreciation, and we'll see that that can impact our income as we go forward here in a couple examples. Another practical issue with the ITC now being increased is that think of the farmer's school tax credit, think of the manufacturing credit. For most farmers out of that 5-year window that Francine mentioned, bigger non-refundable credits will yield you more of those refundable credits back in your pocket, because if you don't got to utilize 10 grand of the farmer's school tax credit, for instance, to offset your New York State tax, because now you have additional ITC, you'll get back more of that refundable credit in your pocket. So there is real cash dollars at hand with regard to thinking about how we claim the ITC and the tools that we have to do so. Take a look at just a generic example of, you got 100 grand of equipment that's used that a taxpayer bought, and you have the choice to either take Section 179 on the asset or take bonus depreciation, otherwise known as SDA. If you're in the 24% federal tax bracket, you're going to have the same deduction federally, right? $24,000 on 100 grand of an expense, right? Pretty straightforward there. New York State, roughly, let's call it 6%. I used in my example of a taxpayer's tax rate. Most of them are around there between 5.85 on one bracket, 6.25. So I just went with 6% there for New York State. New York State does recognize Section 179, so you get that 100 grand of 179 write-off in that third column there. You'll save your New York State tax rate, $6,000. Because New York State doesn't recognize SDA, the bonus depreciation, you can see there in that third column that that depreciation deduction on the state level is much smaller than what it would have been if you took Section 179. The savings difference there, you can see if you took SDA for New York State, you're actually losing out on just over $5,500 of an expense, which would increase your tax rate for the current year. However, now that we got the ITC of 20%, you can see there by taking SDA, we actually get that $20,000 credit back for the taxpayer. So when you net those together, right, you lose some depreciation expense because New York State doesn't recognize bonus depreciation. You increase your investment tax credit. Your net total year one savings is just under $15,000. You can see there in the green, total savings year one. The nice part about this is, if you think about it, New York State is still going to allow you to fully depreciate the asset because remember, if they don't recognize bonus depreciation, you still have 7 years total to write off your 100 grand of used equipment there. You'll get additional depreciation in years 2 through 7 there, which is over $5,000 of tax savings in the future there at the very far column. If you want to get real wonky with this stuff, right, there's tremendous net present value savings on utilizing bonus depreciation compared to just taking Section 179, primarily for the purpose or rather the being of having that additional depreciation for New York State. Plus, you also get the upfront $20,000 investment tax credit. So this is pretty cool. And as you can see, that there are real tangible reasons why taxpayers and advisors want to take a look at bonus depreciation, particularly here in 2022. However, there are still some pitfalls with regard to bonus depreciation. It is nuanced. For 2022, it still is 100%. So in other words, you buy 100 grand of equipment, you can get 100% write-off using bonus depreciation. It gets trickier moving forward unless legislation changes, because in 2023, that goes down to 80%, 24, 60%, 40, 20, until ultimately it goes down to 0 in 2027, barring any pending congressional action there. The middle bucket there, we'll see an example next slide, but you cannot pick and choose assets. The rules require you to essentially use bonus depreciation on any class life of assets. So for example, used equipment is considered a 7-year class life. New equipment's a 5-year class life. Parlors would be 10-year. General purpose barns, 20-year, etc. So anything that falls within those class lives, you have to use bonus depreciation on the entire amount. The final bucket there, New York State AGI limitations. This is a real important one when thinking about bonus depreciation, because New York State, for traditional farmers, that 2/3 test that Francine mentioned, that also applies to the farmer school tax credit. So you have to have 2/3 of your income come from farming. Additionally, though, for the farmer school tax, once you're over $200,000 of New York State adjusted gross income, it begins to phase out. And why is that important? Because bonus depreciation doesn't count for New York State, you may have much higher New York State adjusted gross income. If you wrote off $1 million of a new structure that you built with bonus depreciation and New York State doesn't recognize bonus, but instead only gives you 50 grand of depreciation, you could really have an out of whack New York State AGI. There is a unique rule for farmers there where certain farm debt paid down that's has mortgages, etc., on that property will reduce AGI, but it is important to keep in mind that your New York State adjusted gross income could drastically be different using bonus depreciation, and so that needs to be thought of when it comes time for planning around fall income tax planning with regard to optimizing the ITC and also being aware of the farmer school tax credit limitations. So that middle bucket of picking and choosing assets, you can see here if you bought 3 pieces of new equipment, which I mentioned is a 5-year asset class for the IRS's standpoint, and 5 pieces of used equipment, which is a 7-year asset class. If you decide to take bonus depreciation on one piece of that new equipment, you got to take it on all of it, right? So you can't just take, if one piece costs 20 grand, it's not just that 20 grand that gets bonus depreciation, it's the entire $100,000. That could be good, but it could be too much. Maybe you don't need that much depreciation. And, certainly, did you finance the asset? Did you pay it out of cash flow? That would impact the optimization of how good or bad having to take 100% bonus depreciation is. Because if you finance that equipment purchase and now you got to pay back that debt in future years without a corresponding matching depreciation expense because you took it all in year one, that could cause higher income tax down the road. So there are certainly issues with regard to bonus depreciation. It's not as cut and dry, but it is a useful tool while it's currently in existence. And with the ITC being what it is now, there is certainly a place for taxpayers to think about how to optimize this. The last piece that I'll mention here is thinking about this from an entity perspective, particularly flow-throughs. These credits, as we know, with farmers that are members of LLCs, the entities pass these credits down to the individual, and the individual claims them on their personal return as refunds or non-refundable credits. Certainly, these amounts now getting bigger with the overtime credit. These could be pretty big dollars at stake. Some questions that may arise are, should partners put that money back into the partnership in order to help with cash flow or not? Should they think about amending their agreements to require that to be put back into the partnership? If one partner puts back their refunds and one doesn't, that would impact each partner's respective equity in that business because one would be making a capital contribution, one would not be. So all those things need to be thought about thoroughly as we think about refunds that are coming back to taxpayers. The not so pleasant thing, federally speaking anyways, is that, as we know with the farmer school tax credit, the manufacturing credit, credits that are refundable from New York State, the IRS includes those as federal income. So as you get these refunds from New York State that are actually refunded back into your bank account, we know that the next subsequent year, you will have an increase to your income based on that. So again, further tax planning maybe in that further year. New York State generally does not tax these refunds. They have a subtraction modification, S215 for business credits, generally speaking. So it's more of a federal issue there. But it's important to keep in mind because maybe if you have an extra 40 grand of refundable credits, that increases your federal tax return. Maybe you go from the 0% capital gains bucket, which is just around $80,000 for a married couple, to the 15% capital gains bracket. So that could, for instance, make a dairy farmer go from paying 0% on call cow sales to 15%, depending on the situation. All things to keep in mind. These are all very good credits from New York State, a huge benefit to the farmers here in this state, but it does present a lot of opportunities and some pitfalls if these things aren't thoroughly thought through with your tax advisors come tax planning time. So with that, Chris and Kyla, I will turn it back over to you. Thank you.
Thanks very much, Dario. Really appreciate it. We have a few questions that have come in. Just as a reminder, if you have questions, please type them in to the questions box on the GoToWebinar control panel, and we will answer as many of them as we can get to. So one question that came in, and I will open this up to everyone, I guess, is it relates to eligibility. So you mentioned several farm types that were eligible, but not all of them. And so I'm wondering, are these credits generally available to kind of what we consider agriculture, more broadly, like including, say, greenhouses, cash field crop producers like grains and hay, that sort of thing? Are they generally applicable to the full agricultural tent, as we might put it?
Yes, Chris, I'll take it and proceed, certainly jump in there. For example, the investment tax credit, horticulture, viticulture, floriculture, all those things are delineated in the instructions for the investment tax credit. Obviously, depending on how much of your income comes from farming, right, with the investment tax credit being 20%, the NE's got to have 2/3 of the income right from farming. So if that threshold is not met, for instance, then maybe you only get the prior 4% investment tax credit as an individual who doesn't meet certain thresholds.
Okay, is there a definition that people can take a look at on like the Ag and Markets or Taxation and Finance website of what is perhaps included and perhaps what might not be?
Well, every single one of our tax credit forms when they come out will definitely have the definitions in there as to which types of businesses qualify. And so you can most certainly go onto our website and you'll find some of that information there.
Yeah, Chris, all taxpayers could go, for the investment tax credit, you go to the IT 212. For the farmer school tax credit, you go to the IT 217. For the farm workforce retention credit, you go to the IT 647. And they all do a very nice job of explicitly telling you what farming is on those forms.
Okay, great. Another interesting question came in. If a farm chooses to lower their overtime threshold more rapidly than the 10-year schedule that's been proposed, for example, if they decided to go to 40 hours right away, perhaps due to market conditions or whatever else, would their tax credits be available in a more rapid basis, or would they still line up with the mandated schedule?
The way that the law was written, I believe that we have to have the mandated schedule in order for the credit to go into effect.
Okay, so if a farm chose to accelerate that on their own, they'd be on their own essentially for paying, whatever additional benefit they give to the employee. Okay.
Exactly.
Yep. Another question is, we talk about the amount of applicable overtime. So would that be between, say, 45 and 60 hours, but not over 60, if you follow me, like, during whatever year the 45 is met? Like if they worked more than 60 hours, would overtime for those hours over 60 be covered, the premium?
Yeah, like I tried to illustrate with that table. The way things are now, never would any hours above 60 be eligible for a refund. So 60 would be, so an employee can work more than 60 for the employer, but the employer is on the hook for every hour that they work, and the overtime would apply for all of those hours over 60. If we are for those hours between whatever the future threshold is and up to 60 hours in the week, for the overtime premium portion of that, that's where the states would come in and offer the tax credit to pay for those hours.
Okay, and just to clarify additionally on top of that, Rich, it would be the premium that would be paid. So the employer would still be responsible for the base wage, correct?
Correct. And there's been a lot of confusion about that.
Labor.
Yeah, so it's just the base wage. The employer always would pay that, but it would just be the premium portion. So like in that example, if it's $16 base wage, and then they of course make $24, then it would be the $8 premium. That would be overtime premium that would be reimbursable between the threshold and 60 hours.
Okay. Another question about the investment tax credit, switching gears a little bit. Was the New York State investment tax credit carry forward provision extended? Does that, I don't even know what that means, so forgive me.
Generally a 10-year carry forward for New York State with regard to the ITC.
Okay, and that remains the same?
I think so, yeah. Nothing changed there.
Okay. Okay, couple of other questions here. One is regarding about employee retention credits. Is there any credit that applies to hiring new employees on top of existing employees? Does that make sense?
Well, Chris, the farm workforce retention credit, that does count per employee. So if you hire a new employee that works over 500 hours a year, including H-2A laborers, you would get now $1,200 per that additional employee. There's also New York State, there's a hire a vet credit, for example, if you hire veterans that work certain amount of hours in the year, that would give you a new tax. There's a whole nice range of New York State credits for employment opportunities.
Okay. For a winery or cidery, where there's certain employees that may be eligible and certain employees that may be not, depending on their role at the business. For example, tasting room employees versus field employees. How specific do the activities need to be listed? Like, does it need to say what specific field they may have worked in, or is just that they generally spent their entire time in the field as opposed to a tasting room adequate? Does that make sense? Or maybe it's not even yet to be determined at this point.
I think we're still figuring some of that out, but I think it's very similar to the other credit, the
farm workforce retention
farm
credit.
workforce.
Yeah.
It's got
retention credit, yeah.
exact same definition. So on Francine's slide, she talked about your qualifying agricultural property. You got to be out in the field. You got to be doing farm stuff, right? Your retail employees are not going to count for the purpose of the farm workforce retention credit.
Okay.
Yeah, and let me jump in on that a little bit further. So the FLPA law, that new law, does have a definition in there of what a farm laborer is. And so this, to my understanding, the new overtime tax credit is only for farm laborers. So people working in retail, especially something like a winery tasting room, they are definitely not farm laborers, and they fall under a whole different set of employment regulations. But that one's fairly cut and dry. Where it becomes even trickier is for those employers out there that have processing, vegetable or apple processing, something like that, facilities, and that becomes a question about how much of your own produce is going through that versus how much of someone else's produce might be going through that, as to whether they're a farm laborer at that point or actually a manufacturing type laborer. So it's important to work with your tax advisors to get this right, and to have very good records about when someone is working and what they're working on.
Okay. Another question, I'll kick this one to you, Rich, for overtime calculation. How does piecework factor into overtime calculation? My understanding is that you need to include whatever they're earning in that piecework scenario as their base wage. Is that how it works, or is there more nuance than that?
No, that's right. And I don't have the formula in front of me right now, and that's a pretty involved discussion to get into. But yes, bottom line, piecework is calculated into the base pay rate. So in other words, in some cases, usually when piecework is used, it's only when it's to the advantage of the employee. So in other words, they would get whatever the going rate or the minimum rate is if the piece rate is going to be low, if they're not going to be able to make as much from piecework. But if there's an opportunity where they can make more than that on the piece rate, that's when employers will use that piece rate to the advantage of employees. And in that situation, that is going to increase the base pay for employees, because you have to calculate what their earnings rate is per hour in order to achieve, figure out what that base rate is. And then, of course, when the base rate goes up, because overtime is 150% of the base rate, then it's going to push up the overtime rate as well.
Okay. Couple other questions relating to, I guess, employee tax credits. So can we get a little more specific in terms of some of the definitions of things, like where the line is drawn between ag production labor and what's not ag production labor? Like, would a packing house or a on-farm processing facility be still considered ag production labor for those purposes? Or is there a specific definition that could be referenced?
Yeah, Chris, I guess what I would say is, right, so the question is presupposing we're talking about wineries, cideries for employees on qualified agricultural property. New York State Publication 51, which uses the farmer's school tax credit, that's got, and I mention that because the farm workforce retention credit and this one with the ag employees, they tie back, in the code to this, some of the stuff in New York State with the school taxes, but that publication gives specific examples of qualified agricultural property. So for example, buildings do qualify if they're used in like the raising or production of commodities, for the storage of commodities. Buildings aren't qualified if they're the processing of agricultural commodities do not qualify. The retail merchandising of agricultural commodities does not qualify. Storage of commodities for the personal consumption of farmers or their families doesn't qualify. Those are in Publication 51, which I think is a nice cross-reference to what does it mean to be agricultural production property when trying to look at that delineation of where is the worker working on and what are they working in.
Mm-hmm. Okay. Anyone else want to weigh in on that, or?
Well, I mean, each credit and everything has its own definitions within, that were put within the tax law. So it's very important, again, to read the instructions and the information that we have on the website. They're all some of them are different.
Yeah. Okay. Thanks. I know this stuff gets complicated. I appreciate your sticking with us here. Could we define what property placed in the service means for investment tax credit purposes?
Property placed in service, Chris, it's a term in the tax code for the depreciation, right? You have something that could be used for its purpose. So, right, you get a piece of equipment delivered to your farm, it can be placed in service. You're using, it's not basically, think of it the opposite of this too. You can't order a piece of equipment and it doesn't come to your farm and take the ITC on that. It's got to be at your farm delivered to get ready to do stuff. That's what placed in service means from a federal depreciation standpoint, which is what New York State ties back to when looking at what does it mean to be placed in service. So think of it as the stuff is on your farm. It's not en route, lost on a shipping cargo in the port of LA. Right?
Thanks, Terry. That's what I was going to say. I was going to say you have to be using it. You have to have it on your property.
Rich, a question came in, just trying to get a general sense of the impact of these tax credits and associated regulations. Do you have any concept as to what percentage or how many New York State farms have workers that are working more than 40 hours or more than 60 hours per week? How common that is?
Yeah, that's a good question, and unfortunately, we don't always have data that points exactly to what the question is that's asked. So as far as percentage of farms or employees, we know which groups of employees are typically the higher weekly hours. So prior to the change in the overtime starting in 2020, we knew that typically it was milkers on dairy farms that tended to have the highest number of hours on a consistent basis throughout the year. Typically over 60 hours, often up to like 72 hours was not infrequent at all. So seasonal workers in certain industries, whether it's cropping work, getting the crops in the ground or harvesting, that sort of thing, or apple harvest, fruit harvest there in the fall. There were several specific weeks, maybe even a couple of months, where people would be accumulating a lot of hours in those particular parts of time. But it was the dairy workers that tend to get more hours throughout the year. After the new law came in, overtime law came in, a lot of farmers made changes, and then lots of those dairy farm employees are now where they may have been at 70 plus hours before. Now they're back down around 60 hours, which is very, very common to have cut those hours down to around 60, maybe 65, a few hours of overtime. I know a lot of farmers, their strategy there was to keep employees basically weekly take-home pay the same. And so what that involved, if they were working 72 hours, for example, without overtime, once overtime came in at 60, the calculation worked out to about 63, 64 hours that was the equivalent weekly take-home pay that they had before, with overtime starting at 60. So typically hours got cut back a little bit at that time. A few more employees hired, a few things changed around. For example, employees used to get paid right through lunch, and which was not required. But now, in many cases, employees don't get paid for that half hour, an hour of lunchtime. On average, and this has been stable for a long time, way before overtime, farm employees, when you look across the year, are on average working around 55 hours a week. 55 to 60 is pretty stable. Again, for a long time, that's traditional hours on the farm.
Okay. Pretty quick question here. Is farm worker housing eligible for the ITC credit? Either new construction or substantial improvements?
I would say no, Chris. You know, for the ITC, so you have to use the asset in the production of farming. Now, certainly barns and stuff used in the production would qualify. I'll defer to New York State. Maybe Francine can change my mind, but I would generally.
Yeah, I'm trying to think on this. I'm like, I have to check into it. I don't think it does, but I would need to check into that specific question.
A great question to clarify. I will say there's a lot of investments being made in farm worker housing right now.
Okay. Another question about earning thresholds. And this is sort of, I guess, perhaps almost tangential to what we've been talking about, but I think it's important to clarify. What is the minimum amount of pay where a farmer needs to start doing withholdings, paying workman's comp, taxes, Social Security, et cetera? Is there a minimum threshold below which they don't have to do that?
That's a good question. That's withholding.
And it's okay if we don't know today. That's fine.
Yeah, I was going to say I could get that information out for people. I uncertain on the withholding right now.
Okay.
Yeah, workers' comp, it used to be a little bit higher. I don't have the number on the top of my head. It's quite low. That was one of the minor changes with the new law in 2020. It did lower the workers' comp level, but it's something like $300. It's something quite low anymore. You have to be a very, very small farm, very little labor to not pay workman's comp these days.
Okay. A question about a manufacturing tax credit in New York State. Is that a separate deal, Dario? Are you aware of that?
Yeah, that's a separate deal. Taxpayers used Form IT 641 to claim that. There's been no change to that credit. It's essentially 20% on generally for farmers, town and county taxes. It can be technically more than that, but since most farmers get the school tax credit on the school taxes, you can't use the school taxes for the manufacturing credit for farmers. So generally for most farmers, they get a separate credit that hasn't been changed this year in the budget, 20% back on town and county taxes.
Okay. We've gotten a few questions that are, just to people that have asked. I'm not intentionally skipping over questions, but some of them are a little too specific for me to really get into, because I'm also not sure of all the information that might be applicable. But can we go over perhaps a quick review of the employment tax credits and when you start being eligible for some of them, like for say the employee retention tax credit? Does that mean that you kept the same number of positions open from year to year? Or if you increase the number of positions that you offered on your farm? I guess a little bit of confusion on that. Maybe go back to basics.
Okay, hang on. Give me a second.
Sure.
So are they talking about the employee overtime credit? No, they're not.
No,
the employee. Sorry, I part of that. The workforce
retention
credit.
tax credit, I believe.
Oh, we didn't have the specific details on that.
Yeah, Chris, there's no, the farm workforce retention credit, and I think somebody said employee retention credit, maybe they may be.
Yeah, farm workforce retention, that's what
Farm workforce retention credit has nothing with regard to anything you mentioned. The only criteria there is you got to work the 500 hours. So you hire somebody, they work the 500 hours. They're not a general executive of the business. You get that $1,200 per worker. So the only test to answer your question, Chris, is did they work the requisite number of hours for that credit, and they're not a general executive of the company, basically.
Okay, so they could be
Right.
part-time or seasonal and still qualify as long as they meet that threshold.
Exactly. It's a flat amount per employee, so yes.
Okay,
It's an individual who's employed for 500 hours or more per tax year by a
Yep.
farm employer.
okay, good to know. So I think we've covered most of the questions. For those of you whose questions we didn't get to, I apologize. We will be following up with everyone whose questions we didn't answer live with more information. So look forward to that. As long as we have your emails, which I think we got when you registered. Rich, do you want to perhaps give us a wrap up and perhaps a look ahead?
Yes, thanks. And again, thanks all of you for your time and for the experts who were able to jump on here and join us. I really appreciate that, and Farm Credit East for hosting us. You know, I still run into farms out there that aren't tracking hours of employees and in some cases aren't paying overtime as they should. Just a couple of quick things to remember. Just for example, just paying salary doesn't get people out of overtime. It really salary only is a method of paying. It doesn't control overtime. So remember, those things get into some complexity. There are certain groups of employees, certain supervisors, managers can be, as long as they're supervising 2 or more people, can be exempt from overtime, and then some professional staff and so forth can also be exempt. But you need to understand and make sure that they are eligible for being outside of overtime, as well as remember family versus employees who potentially can be exempt from overtime. Again, it depends on the situation, and I encourage you to become familiar with those things and make sure that you're in compliance. Excellent records. Nicole mentioned that it's important to keep records, good records, payroll records, and going forward, it's just going to become that much more important. Please make sure you've got good records of how much people are working, when they're working, and now increasingly, and I don't know all the details to this, but where they're working, to some degree. So if it's mainly a home farm where they work, then certainly you'll have track of that. But we may need to have more detail about that, and it is unclear. We don't know the answers as to exactly where, how much information we'll need about where they're working. But I just want to reemphasize, keep good payroll records. Look at some of the newer software that is out there, new means to keep that, because you can use that for management purposes, maybe to understand which crops or enterprises are most profitable if you know exactly where all that labor is going. I think that the investment tax credit and the workforce retention tax credit are maybe a little bit more straightforward, and we know how that's going to roll out, but pay attention to those overtime tax credit. There's still several question marks out there, and we have to understand those details and make sure that we get them right going forward. This is going to take some educational efforts, and all of us who were involved in putting this call together are committed to continuing to get in front of you and to help all of those farms that are eligible for the overtime tax credit to know how to apply for it and how to take advantage of it, because you're going to have to actively apply for that in order to get that tax credit. So we want everyone who's eligible to be able to take advantage of that. And so we're going to be coming back when those details become clearer, and I want you to make sure that you stay tuned there so that you know exactly how to apply and what information you're going to need going forward. Thanks to all of you for joining us and all of your efforts to supporting a strong ag industry in New York. That's all I had, Chris. Thanks.
Yeah, thank you very much, Rich. A couple things that I wanted to mention before we wrap up. One is that if you haven't done it in the past, now might be a time to consider the use of a payroll service to help you with these record-keeping responsibilities. Farm Credit East does offer payroll services. There are others out there as well. So I just want to make sure that people are aware of that. The recording and materials from today's webinars will be posted at farmcrediteast.com/webinars. We will post it at by the end of the day, I believe. They're not there yet, but they will be up. The recording as well as the materials, as well as information on all of our past, present, and future webinars. That's where we keep all that information. For those of you that employ minors, teens, people from say 16 to 18 years old on your farm, we have a recording of a webinar there that might be worth reviewing as well. Because there's very specific child protection regulations that you need to comply with also that we obviously didn't talk about today. So with that, I will thank everyone very much for their time, thank the presenters for their expertise, and we will adjourn. Thanks a lot, everyone.